Okay, let's jump right into this explainer because we need to face a pretty serious reality. The Indian Income Tax Department, yeah, they have a very, very long memory. If you're an NRI and you have money sitting back in India, maybe a fixed deposit, an old family flat, or a few stocks, ignoring your taxes could literally lead to frozen assets and massive penalties. And you know what the worst part is? Most non-resident Indians don't even realize they're officially supposed to file.
So, here's the question that completely stumps most expats. If you earn money in India, but you actually live and work in, say, the USA, the UK, or Dubai, does India actually have the right to tax you? Well, the answer depends entirely on a few specific numbers. And honestly, getting those numbers wrong could end up costing you lakhs of rupees.
I know, tax law can feel super intimidating, but we're going to guide you through a clear 6-step roadmap to get you fully compliant without all the stress. We'll hit 1. The 182-day NRI rule. 2. Mandatory ITR filing triggers. 3. NRE versus NRO account taxes. 4. DTAA, which stops you from paying twice. 5. E-filing your ITR too. And finally, 6. The July 31 deadline and penalties.
Section 1. The 182-day NRI rule.
Okay, this entire tax code basically pivots on one single magic number, 182. Why? Because it represents exactly half the year. It's the ultimate metric that dictates your legal residency status in the eyes of the Indian tax authorities. You might work abroad, you might send money home, but every single July you absolutely need to know if you cross this specific threshold.
Figuring out your status is actually as simple as a 2-step decision tree. Step 1. Count the exact number of days you spent on Indian soil during the financial year. And remember, that's from April 1st to March 31st. Step 2. Is that number strictly under 182 days? If it is, boom, congratulations, you are officially an NRI for tax purposes.
Section 2. Mandatory ITR filing triggers.
Now, even as an NRI, you must file a return if you hit any of these 3 clear triggers. Trigger 1, your Indian income exceeds the basic exemption limit of 2.5 lakh rupees. Trigger 2, you deposit over 1 crore rupees into an Indian current account. And trigger 3, this is the one that usually catches people off guard, spending over 2 lakh rupees on foreign travel or paying over 1 lakh rupees in electricity bills back in India. Tick even one of these boxes and you are legally required to file. No exceptions.
Section 3. NRE versus NRO account taxes.
Let's strip away all the complicated financial jargon for a second. The difference between an E and an O dictates your entire tax strategy. Your NRE account, which holds the foreign income you remit back to India, is completely tax-free. But your NRO account, which holds income generated inside India, like rent from a property or stock dividends, is fully taxable. Mixing these two up is literally the easiest way to accidentally hide taxable income, or worse, leave your hard-earned money on the table.
Section 4. DTAA. Stop paying twice.
Right. So the Double Taxation Avoidance Agreement, or DTAA, is the absolute hero of expat tax strategy. Think of it as a powerful treaty shield, ensuring you don't pay tax twice on the exact same income. If you earn income in India, but pay taxes in the USA or UK, the DTAA allows you to claim tax credits. Simply put, you should never have to pay 2 different governments for the same rupee.
But hold on, because here is a massive, incredibly dangerous misconception, specifically for our UAE residents. In the US or the UK, the DTA applies directly. You pay tax there, you get a credit in India. Simple. But in Dubai, there is 0 local income tax. So a lot of expats assume 0 Dubai tax automatically means 0 Indian tax. Guys, that is completely false. You are still fully liable for taxes on any Indian-sourced income. Do not fall for that trap.
Section 5. E-filing your ITR too.
Okay, here is the exact action plan to get this done. First, just head over to the official income tax e-filing portal. Next, and pay attention, this is absolutely crucial, you must select Form ITR2. Do not accidentally file the standard resident ITR1 form because the system will just reject it flat out. Finally, here is a pro tip for you. Use a digital signature certificate, or a DSC, to verify your return. It saves you from having to mail physical verification documents thousands of miles back to Bangalore.
Section 6. July 31 deadline and penalties.
Look, getting this done on time is absolutely non-negotiable. If you miss that July 31st deadline, you immediately face late fees of up to 5,000 rupees. But honestly, a fee is the least of your worries. If you continually fail to file, you'll be hit with official notices, compounding interest on unpaid taxes, and ultimately asset freezing. That's right, the Income Tax Department holds the real power to freeze your Indian bank accounts and attach your properties.
Staying compliant doesn't have to be a nightmare when you have the right roadmap, but it does require you to actually take action. So, which country are you filing from? Drop it in the comments below so I can answer your specific DTAA questions in our next explainer. And as we wrap up, ask yourself this one question. Is the money you left behind in India currently a growing asset, or is it a ticking tax time bomb? Review your 182-day status, check your NRE and NRO accounts, and get that ITR2 filed before the July deadline. You've got this.